Barclays has finally unveiled drastic action to deal with its floundering investment banking operation. After months of foot-dragging, the bank is to withdraw from parts of its fixed income, currencies and commodities operations, setting up a non-core division to wind down on economic activities. Can the change of tack reverse the slide in the share price, down 10% in the past year? And can it convince investors that Anthony Jenkins should remain as chief executive? Well, to answer those questions, I'm joined by Martin Arnold, our banking editor. Martin, do you think investors will be convinced?
I think investors will look at this and wish that Barclays had done more. They will applaud the direction of travel, but say that Barclays should go further. We're yet to see whether this is enough to save Anthony Jenkins' job, but it's true that he is under enormous pressure.
Yeah, one of the things that a lot of investors have been saying for months now is, why hasn't this come sooner? There's probably no real answer to that other than it was a very complicated restructuring to put in place. And we can see some of the evidence of that in the way in which the whole investment banking operation is being split down the middle, if you like, including the management being split. So Tom King going off to run the core bit of the investment bank, the ongoing business, and a non-core division being set up with his previously his co-head at the investment bank, Eric Bomonsath. Is that a good idea?
I think so. I think in terms of division of labour makes sense. Tom King is more of a classic investment banker, a corporate financier, relationship driven, and he will continue to run that side of the business and the overall investment bank. But a lot of the trading activities are being shifted into this bad bank, which will be run by Eric Bomonsath, and he comes from the trading side. So it makes more sense for him to run that operation, and he's more of a geeky, in the details, introverted type of personality. So you need someone like that who can manage the minutiae of running down and selling a lot of these underperforming businesses. You asked why it's taken Barclays so long to get here, and I think part of that is regulation. And they've been waiting to see all the different forms of regulation come to a head and get more detail on that before deciding their strategy, but they have been left behind by some others. So Tom King and Eric Bomonsath have got their work cut out to catch up.
One final thing, there do seem to be a couple of contradictions in this whole announcement. Firstly, we're seeing a shift geographically towards the US. Tom King is an American, he's based in the US. And we're seeing a wind down of the fixed income franchise at Barclays, which has traditionally been Europe-based, in favour of the kind of more equities-focused Lehman Brothers franchise they acquired in the US. At the same time, we're seeing some of the top former Lehman Brothers people leaving, including Skip McGee, as we revealed a couple of weeks ago, the former head of the US operation. Does this, and also the fact that a lot of these people were paid huge bonuses in a year of falling profits, controversially among investors, of course, doesn't that signal that there are contradictions at the heart of this plan, which are not going to go down very well with shareholders?
Well, you almost answered the question yourself there, Patrick. But yes, I think that increasingly, as every day that's gone by in the past couple of weeks, we've seen yet another departure of a top name, a high-level senior banker in Barclays Investment Bank. Many of them are part of the Lehman Brothers alumni. And Sir David Walker, the Barclays chairman, and Anthony Jenkins, the chief executive, both put up very strong arguments in defence of the rise in bonuses last year, despite the fall in profits, by saying that without that rise in bonuses, there would be an exodus of a death spiral, as Anthony Jenkins put it, of top talent to other banks who'd offer to pay them more. Now they paid those bonuses, and yet now we're seeing a string of these departures. So it looks as though they got that one wrong, or they were right, but the medicine that they prescribed only lasted temporarily. The risk for them, as you've said, is that they've now put the emphasis very much on the classic investment banking side of things. And if there is a mass exodus and that continues and it damages their franchise and hurts their ability to win new business, then this could be that could unwind the whole logic behind this strategy.
I suspect, as you said at the beginning, investors will welcome what's come give them some time to implement. But if there's any more glitches along the way, I think Anthony Jenkins' time could be up.
Certainly.
Thank you, Martin.